Is SanDisk stock a hidden bargain or is it a dangerous bull trap? The charts are flashing clear sell signals and the downward trend is hard to ignore. Yet some of the smartest contrarian investors are quietly calling it massively undervalued right now. Who is right and where is the smart money actually moving? To understand what is happening, we have to look at what SanDisk actually does. This is a foundational giant in the global data storage and flash memory ecosystem, specializing in the development and manufacturing of flash memory cards, solid-state drives, and digital storage solutions that power everything from mobile devices and enterprise data centers to massive cloud computing setups. When the demand for consumer electronics expansions and high-speed data infrastructure grows, SanDisk booms. When global memory chips face oversupply or data storage hardware investments hit a temporary lull, it hits them first. Right now, this stock is heavily in focus because it serves as an ultimate health check for the entire global semiconductor sector, hardware technology pipelines, and industrial memory market valuations. Before we dive into these critical chart levels, make sure to like this video, subscribe to the channel, and drop a comment below with your current strategy. Are you buying this dip or are you sitting on your hands? Seriously, leave a comment right now. It helps the algorithm push this out to more traders. Let us pull up the charts and look at the raw technical analysis. The immediate trend direction is showing clear, consecutive lower highs and lower lows. We are seeing immediate short-term weakness as the price tests a major horizontal support level. If this current support zone breaks, the next major downside target opens up significantly lower, creating a vacuum that could accelerate selling pressure. On the flip side, momentum indicators like the relative strength index are hovering right on the edge of oversold territory. This tells us that while the sellers are firmly in control, the downward move is getting extended. Key resistance sits just above the recent breakdown point. Any relief rally is highly likely to face heavy selling pressure at that resistance line unless we see a massive spike in buying volume. When you look at Wall Street ratings and the broader institutional signals, the picture looks incredibly cautious. A significant number of consensus analysts have recently downgraded their outlook, shifting their ratings toward hold, sell, or even strong sell. The prevailing short-term outlook is dominated by negative signals, primarily driven by a temporary oversupply in flash memory markets, declining commercial component pricing, and elevated inventory levels across the distribution channel. This institutional pessimism is putting a heavy cap on any short-term upside potential, leaving retail traders to fight against a massive wall of corporate sell orders. This brings us to the ultimate debate. Is SanDisk genuinely undervalued, or is this a classic value trap? The fundamental bulls argue that the company's price-to-earnings and price-to-sales ratios have dropped to historic lows compared to its long-term average, making it an absolute steal for a company with such a dominant and necessary market share in hardware storage infrastructure. They see a massive margin of safety built on unavoidable long-term digital storage and data proliferation demands. But the bear counter argument is that traditional valuation metrics are completely deceptive at the top of a highly cyclical memory chip market. If corporate earnings contract because global hardware spending cools down or competitor pricing slashes margins, then a lower valuation metric today just means the stock is going to look much more expensive tomorrow. That is exactly how retail traders get trapped. They buy what looks cheap on paper, completely ignoring the underlying cyclicality and macroeconomic headwinds. The downside risks here are very real, and the volatility is starting to expand. SanDisk is heavily tied to the cyclical capital spending budgets of consumer tech brands and major enterprise clients, meaning its revenues are incredibly sensitive to global consumer spending adjustments, manufacturing material shortages, and intense chip pricing pressure. If key enterprise sectors dial back their data facility upgrades or switch to cheaper generic alternatives, profit margins shrink rapidly. For retail traders, the risk is getting caught trying to catch a falling knife. Volatility shakes people out of their positions, forcing stop losses to trigger right before potential turning points. Let us map out the official bull versus bear case so you can see how this plays out. In the absolute best case bull scenario, we see a surprise stabilization in high growth equities and a massive new wave of consumer demand for next generation hardware devices, prompting a sharp short-term short squeeze. Buyers step in at current support, volume spikes, and the stock invalidates the sell signals by reclaiming its moving averages, opening the door for a steady recovery back toward previous highs. In the worst case bear scenario, the current support level completely snaps on heavy volume. This triggers an automated wave of algorithmic selling, confirming a continuation lower and driving the price down to major multi-year psychological support floors before any real accumulation begins. Looking at the outlook, the short-term perspective remains incredibly cloudy and heavily skewed to the downside due to these persistent technical sell signals. However, the long-term perspective reminds us that high-speed data processing, enterprise data storage arrays, and mobile memory systems never permanently disappear. Eventually, cycles turn and dominant market leaders recover. But that leaves us with the ultimate question for the days ahead. Are we watching the final capitulation before a massive, historic rebound? Or is this just the quiet beginning of a much deeper structural collapse?